Lan Turner is a seasoned finance educator with over 2 decades of trading experience. He's taught at prestigious institutions such as the Chicago Board of Trade and Mercantile Exchanges, Utah State University, and currently Utah Tech University. As an entrepreneur, he's the founder and driving force behind Gecko Software, developers of cutting-edge, award-winning trading platforms for the financial markets, stocks, futures, forex, and options. His brokerage firm, Gecko Financial Services, also specializes in futures, options, and forex trading. Mr. Turner is the editor-in-chief of Pitt News Magazine, offering valuable insights for traders. Beyond finance, he's also an avid real estate investor and private pilot. Explore Mr. Turner's contributions to the financial industry online at trackandtrade.com, geckofs.com, and pittnews.com. It's great to welcome you to our community. Now, here's Mr. Turner.
Good morning. My name is Lan Turner. I am your host here with Stock Market Trading Channel. Doc Brown is on vacation, and so I am your substitute teacher today. And so what we're going to do is we're going to go through, and guess who sent me an email? Jim Cramer sent me an email today, and he's told me a whole bunch of stocks that he thought I should take a look at. And I thought, hey, you know what? This would be a great thing to do with our Stock Market Trading Channel class. So we're going to come in here and we're going to take a look at the stocks that Jim Cramer is recommending, and we're going to apply technical analysis to them. Now, Jim Cramer is a very good fundamental analyst. All right, he's very into the fundamental nature of markets, and he sends out these emails talking about the reasons why stocks might go up or down. But he's only about the fundamentals. He's not about the technicals. He doesn't do very many technicals. Now, some of you might know Carly Garner. You see her on CNBC on occasion with Jim Cramer. She was one of my students at one point. You're one of my students here today. You may end up on CNBC just like she did. All right. So at one point, Jim Cramer sent out this email, and again, he is all about the fundamentals, not so much about the technicals. I'm all about the technicals. Not that I don't love the fundamentals. I certainly do. We know that the fundamentals drive the long-term trends, right? And it's the technicals that give us the setups and the triggers to know when to enter those long-term trends. Because just because a stock has good earnings, or just because some good news comes out for some reason, you know, get a new CEO or whatever, that doesn't mean, oh, hey, I should go buy today. You know, we got to have setups and triggers. We got to know when the market's going to run. Doc Brown talks about this a lot, right? He's looking for specific setups, and those are called technical setups. Now, he's very much paying very close attention to the fundamental nature of markets, but we're looking for technical setups for the entry. Setups, triggers, and follow through, right? Count, measure, setup, trigger, and follow through. That's our little mantra that we run here, and we want to make sure that we are on board. So I have that brought up here for you, and I just want to kind of show it to you. This is our little mantra, and we talked about this yesterday. For those of you who missed the class yesterday, what do we do with our trading strategy? We count. What do we count? We count the Elliott waves. Markets have a tendency to go through 3 drive patterns. Now, it doesn't mean they can't go 4, 5, 6, 7, 8, 9, 10. They certainly can. It doesn't mean they can't stop at 1 and 2. They certainly can. It's just that if you go back and look at 10 million charts, you're going to find that on average, they have these 3 drive patterns. And so for us as small speculators, we want to go with the highest probability, right? So once a market gets into a low probability of success, we don't really want to trade that. Doesn't mean it can't go further. It doesn't mean it can't go out into those really, low probability zones, but it's not for us to trade. We want to just kind of try and stay in that solid high probability trading zone for us as small speculators, all right? So we want to count. We want to know where we're at in the count. That's very important to us. Now, I worked over at in Chicago at the Chicago Board of Trade and the Chicago Mercantile Exchange for almost 10 years. I was there. In fact, it was probably a little more than 10 years. And I went and studied with these great traders from Chicago. And although I was a teacher there, I learned more than I ever taught. And so one of the things that they taught me was this Elliott wave strategy and this Fibonacci thing. That's a real thing, and they use it very seriously. All right, they take this stuff very seriously, and so we want to do what they do. We want to know what they know. They know Fibonacci. They know Elliott wave. All right, they know this stuff, and so this is very important for us to apply to our trading as well. Now, we also want to know about recurring price patterns, setups, and triggers. This is what gives us the breaking points that gets us into a market, makes us decide, hey, this market had great earnings. Let's look for a setup and a trigger for an entry. And then, of course, the follow through. How do we get it? Once we get into a market, how do we get out? So what I want to talk to you about today is I want to go through and I want to look at Kramer's different strategies or different markets that he's recommending, and then we're going to do a little technical analysis on them, and we're going to apply the probability tables to them. And so the probabilities table is very much like when you go to Las Vegas and you go to the blackjack table and they give you one of those little player cards, right? And you can look it up and you can say, okay, left, right, and I can go across, oh, my probability of winning this hand is XYZ based on my little winner card. Well, we can do the exact same thing with the financial markets. So we have our player card in the financial market. And so that's what this is. This is kind of our little player's card. Now, this is the cheat sheet side of it. You really kind of need to understand it at a greater detail than just the little cheat sheet. But here's an example of how we would draw this out on a normal chart. So we're going to count, we're going to measure, and we're going to label these different settings for our probabilities. All right. And if you don't know how to do this, then you need to learn. I mean, it's all about learning. You're going to have Doc Brown just come in and tell you, oh, buy this. And, okay, I'll just do what Doc Brown does because he's a superhero trader and has made lots of money. So I'll just do what he does. And that's great. That's wonderful. That's why you're here. But I think it's nice, show a man, give a man a fish or teach a man to fish, which is better. So I'm going to teach you how to fish. So this is how we count, measure, set up, trigger, and follow through. And this is our probability table. And if you would like to learn a little bit about how to get a probability table, of course, I have a book where I've published all this information, and you can go get the book. It's out on Amazon. Just search Lan H. Turner on Amazon, and this book will pop up. It's 220 pages of how to do this trading like this, how to do the setups, triggers, follow through, the Fibonacci, the Elliott wave. And we're going to do that here in this class, and we're going to do a little bit of it. But to get the manual to the class, which is what this is, you can get all these probability tables out there, and it shows you in great detail how to use these and how to do these. So you just go out to Amazon, search Lan H. Turner. You can get the manual to this class. It's like, I don't know, it's like $30 or something. It's nothing expensive. It's not like a $200 class. It's the manual to this class, all right? So go ahead, get that, and then we're going to take you through and show you the probability table, and we're going to do a little counting and measuring here on the stock recommendations by Kramer. So Kramer, and so anytime you get a stock recommendation from anybody, whether it's Doc Brown, whether it's, your buddy from across the street, your neighbor, or your uncle, lots of people give stock recommendations. You might even subscribe to somebody like Jim Cramer, who sends these things out willy-nilly, right? There's lots of people always giving stock recommendations. Well, you need to be able to do your own analysis on those stock recommendations to know how to trade them. All right, so let's go over, and we're going to jump over to the software. Actually, let's go to Jim Cramer's email first. Let's read what Jim Cramer's recommending. So he says the Wall Street is headed for a lower open after a mixed session Monday in which the S&P 500 NASDAQ rose, but the Dow fell. We're going to skip that. He also talks about a merger between Cortona and Devon. We're going to skip that. I'm going to come right down here to his section number 3, and we're going to talk about Honeywell. All right. Citi put out an outrageous $1 per share price target bump to $244 on Honeywell after it closed the purchase of carrier security business. Honeywell needs to do more good deals like this and shed low-performing business. All right. That's his fundamental take on Honeywell. So what we're going to do is we're going to go over to Honeywell, and we're going to take a look at it. And we're going to say, well, what do we think of Honeywell? Well, first thing we can see is we've got our bulls and bears turned on, which is our Fibonacci and our Elliott wave, which is our count and measure tool. But we see that this market's just been going sideways. And we don't like to really trade sideways markets, although you can see that this market is breaking out right here on this trend right here, breaking above the blue lights and starting to rally. So we also have a horizontal line right here. This is the previous high. So this is kind of a yield sign, or a stop sign is what we call that, right? The market might go up and hit that and bounce off of it and fall back down. So that's a very important number for us to break through. Now, oftentimes I like to do what we often say, right? Buy low, sell high. So I'm more of a guy that likes to buy down in the valleys, buy the valleys and sell the rallies. So I like to buy down here when we get a crossover of the blue lights, and then I like to buy down here when we get a crossover of the blue lights. And when it comes up and it has a stop sign like this might be an area where I'm going to tighten my stop. Be very careful, because I know, hey, it might not break through there. But if it breaks through there and it closes above it and it holds above it, that's usually a good sign, and we want to go ahead and stay in the market or add into our position. Now, markets oftentimes will rally up, right? They come up and then they come back down, and they use that area of resistance turn it into support. And so that'll come down, use that as a floor, a stop to the downside. It'll stop there and then turn around and go back up. So sometimes if I'm coming out of a trend like this, rather than being, aggressive down in here, probably don't want to buy that down there. I'm going to miss that one because heck, there's one. That market's not been very consistently going long. Now we do have what we something call 3 times as a charm, right? So when you're going through a sideways market like that, usually it'll bounce once, then it'll bounce twice, then it'll bounce 3 times, and it's on the third try that it'll try and take off and go again. So keep that in mind as well. It doesn't always happen, but happens more often than not, and it's something that we can just keep our minds on. We want to correlate that, of course, with a fundamental nature of the markets. Now, as the market starts to rally, you can see it's starting to make this little A, B, C, D pattern. Now, markets move through waves, right? 2 steps forward, 1 step back. 2 steps forward, 1 step back. Definition of an uptrend is higher highs and higher lows. Definition of a downtrend is lower highs and lower lows. So we are now in a uptrend. How do we know that? Because we have a lower high and a lower low. We have a higher low and a higher high, and we have a higher low and a higher high. So there we go. So we got 2 higher highs and 2 higher lows. That makes an uptrend, right? So when it broke above this point right here, that was a confirmation that we went from neutral, or in this case neutral, to an uptrend. So we are now in an uptrend. We have that confirmed because we are making higher highs and higher lows. So now what we want to do is we say, well, we should have brought in right here. We should have bought right there. Well, we didn't buy right there. So now what we want to do is we want to see if we want to get into this market or not on Cramer's fundamental reason for getting in. He says, hey, let's get into this market. All right, well, I'm going to wait and see if things are going to continue higher and if it's going to pull back and rally and do one of these A, B, C, D patterns, all right? So that would be a bow tie. We call that a Fibonacci bow tie. So this point right here becomes very important to us. And it's just a little bit below this previous high. So we're going to have an area in here. And oftentimes when we're trading, it's not exact numbers. It's a little area. That's why we always say an area of support, an area of resistance. All right. So we have this little area of resistance right here, which is actually support. It's going to become resistance. But we get what we call a Fibonacci bow tie. So we draw a line from this high here down to the low. And then we're going to project, which is a Fibonacci projection, right? We're going to project out into the future. And then we're going to anticipate a pullback to the Fibonacci resistance zone, which if you tie that off, which is right there, that becomes a Fibonacci bow tie. All right, so that's a bow tie. And now if the market turns and comes back down, if he makes a perfect bow tie, which it rarely does, but oftentimes you'll see that it makes perfect bow ties. Be surprised how often it makes a perfect bow tie. All right, I'm going to delete all these arrows. And so now we have this little bow tie projection. So we're going to anticipate the market's going to break above this median point here, but then it's going to pull back down and it's going to test this previous low or this previous high here. So that's going to be an important area for us. And we're going to draw this as a sideways thing in here, like that, kind of like that, right? So this market's going to pull back into this region here, and then it's going to turn and it's going to rally once again. That's what we're going to anticipate. Now, does it mean it can't do something like this? What if the market just comes in here and it says land? It says get in right here, and it just goes straight up forever, and you miss it. Okay, well, those kinds of things happen. Do they happen? Yes, they happen. Sometimes markets just take off and they just go to the moon and they never look back, and you're like, wait, I'm waiting for the pullback so I can get in because I want to buy the valleys. Land said buy the valleys and sell the rallies. This is not a valley. This is kind of a rally. It's a breaking above a previous high. A lot of people want to buy there, so it's not a bad place to buy, but hey, I'm one of these guys that would prefer to buy down in the valley somewhere in here. And so I'll draw a natural trend line in here across these bars like that. And if I'm interested in getting in, there's an arrow from our indicator saying the market's breaking through the neutral zone into the bullish trend. I might want to put one in there. There's also another trend right here, which is the blue light, and then of course there's another one on the horizontal right there. I call that the spider web, all right? And of course that's in the manual as well. And we talk about the spider web, and we talk about getting in here on the first break, or we get in on the second break, which is the mathematically calculated break, or we get in on a break above the previous high. So that's a little ABC pattern, and those are different areas that you can get into. And of course they have probabilities, and we talk about the probabilities of each one and how you might want to trade those, okay? And what the anticipated projection is on those. So we're going to go in here. Again, I'm going to delete all the drawing tools, and we would just take a Fibonacci projection tool, something like this, A, B, C, right? Now this gives us a Fibonacci projection, and it says, hey, if the market comes in and it stays at the same volatility scale and the same volatility and time scale, so we can make a projection, price and time. So we can push market prices out, and we can say, well, if it continues on this same scale, we would expect or anticipate that this market would be out here at 100 to 130 points 130.9, which is a golden ratio, right? A Fibonacci golden ratio number. 130.9, and we can line that up, and it says down here at the bottom, it says June 25th. So around June 25th, if it stayed on this same volatility scale, we would expect this market to be somewhere around $2.18 a share. That's a kind of a nice little tool. Again, it's just a guesstimate. It's just kind of a nice projection of where we can anticipate markets going, and you might want to do something like that. We can also do, there's a couple of other fun little things we can do, and we can learn about this. This is also in the manual, where you do what we call a Fibonacci cone of probability, where it kind of makes a little cone like this, where you have a couple of little bottoms in here and a little same top, same pullback, and you end up with what we call a cone of probability. And the market's going to probably go up through that little cone of probability. You can see it's being a little bit more aggressive right now, so it's pulling up a little higher, but generally it kind of stays in that little cone of probability. That's just a Fibonacci mathematical model. That's all that is. It's projecting out into the future of where we think this market might go at any given time. Now, once it gets up there, it's not going to go straight up generally. What we do is we'll get it to come up. It'll come up, and then it'll pull back and makes that Fibonacci projection like that, or that Fibonacci bow tie. And then we would expect it to turn and rally and do it again, right? So that's how you get bow ties. It just goes through a Fibonacci series of bow ties. And the reason it does that is because it knows the market gets in, then it comes down, stops everybody out, and then it goes up again, and then it comes down and stops everybody out. You ever got caught in one of those? I have. All right, so that's what we're looking at here on Honeywell. Let's go over and take a look at and see what old Kramer's saying about next. Let's kind of spend a little bit too much time on one chart, but I think it was good to spend a little time, and then we can go a little faster on the next one. So how's that? So we're going to come in here and we're going to look at Barclays. Barclays said the report layoff of club name Microsoft shows that the software AI and cloud giant is committed to profitability. We all love Microsoft, right? We love to hate them for one thing, and then we love to use them. So we love Microsoft. We have a love-hate relationship with them. At least I do. You know, we love Microsoft. We also hate Microsoft. Why do we hate Microsoft? I don't know why we hate Microsoft. It used to be they were the giant on the world stage, right? And so everybody wants to hate the world giant, and now they're not the world giant anymore. Now Google is. Now everybody hates Google. So I don't know. It's just fun. It's just playful. What we're really doing is we're just looking for opportunities to make money, and that's really what it's all about for us. So as we come back here and we take a look, we're going to come and look at our drive patterns. All right, let's look at it. Here's where we get kind of a new start right down here with this big red pullback, and then we got kind of a little drive here, but there's a nice big drive there. So we got kind of call that drive 1. We got a counter trend and another drive 2, a counter trend, and there's drive 3. So there's your 3 drive pattern. Now they're not always beautiful and perfect. Sometimes they are. They're just as clean can be. This one a little bit dirty. So you got drive 1, you got your counter trend in here, you got drive 2, you got your counter trend in here, you got drive 3. Once we get up to drive 3, we as small speculators, we no longer want to be kind of trying to go long up here. We want to wait for the market to give us a little ABC retracement pattern, right, to come back down a little bit so we can buy the valleys and sell the rallies. Well, how far do we expect it to come down, Lan? Well, sometimes you expect it to come down a nice full ABC pattern. So we come down ABC, and we'd look for something like that, and then we could measure from the low of the trend all the way to the high of the trend. And this is something that we'll look for the market to come back into what we call the Fibonacci sweet spot back in here. Now, it doesn't mean it has to come back that far. It's just nice if it does. So some of these strong markets, like Microsoft is obviously one of these very strong markets. It might not come all the way back into the Fibonacci sweet spot or the Fibonacci drop, okay? So in this case, it went all the way back up and it tested the previous high. So this is something we need to be very aware of, and we're going to come in here and we're going to draw this line across the top. And again, it's not going to be a specific line. We're not engineers here. We're not building buildings. It's going to be more like a soft top. Let's call it a soft top, all right? So we all like convertibles. It's kind of a soft top. So it's really an area of resistance up there, all right? So we kind of draw this little channel up there. The market likes to go up and kind of hang out in that channel, break down, go up and test that little channel. It wants to see if it can't get past that channel. If it can get past that channel, then we can go up and create that bow tie, right, and come down and test that. And then we can turn, and from that, use that as a launch pad, and that's where we can use our next rally point. And you're like, well, Lan, where do you get that idea? Well, just go back and look from history, and that's how it's kind of done it in the past. Market goes up, and then it pulls back, uses the previous high, and then it goes up, and it pulls back, and it uses the previous high. It goes up, and it pulls back, and it uses the previous high. Now, the second drive is oftentimes the highest. It's the longest drive. You get the best drive out of the second drive. The first drive, now in this case, it was a pretty good first drive. We got a little bit of a pullback right there, but then we got this first drive, a little bit of a sideways, and then we got a nice, beautiful drive, a little bit of a sideways, and then the smaller drive. The third drive, that C drive, is oftentimes the one that struggles. doesn't quite do as well, right? So that's kind of the market's petering out up there on that third drive. Let's go ahead and label these real quick just so you kind of get an idea of what's going on. This is going to be what we call our A1, all right? It's the first breakout. We oftentimes miss the A1 because we don't know the market's going to take off and run. So oftentimes we get in on what we call the A2. So right in here, this would be an A2 in here. Now sometimes, again, they're prettier. Sometimes they're not quite so pretty. But you get the first rally, and then it's that first little pullback like in this. As you kind of get a little pullback right in here. See that, how we got that little pullback? That's our A2. And oftentimes we miss the A1, and we do that on purpose because we don't know if the market's going to go. We don't want to get in until a market really proves it wants to go. And then when it makes that first little pullback, boom, it takes off again. That's the one we want to get in on. That's the A2. That's my favorite anyway. Then you got another little break here. It's almost like an A2 there, but it just went straight up like a rocket ship. And so this was the A2, and technically speaking, I mean, if you're going to be like the engineer, again, we're not like engineers, but A3, that would be an A3 right in there. And generally we'll get 3 drives inside of each one of the drives. It's called a fractal drive, all right? So you get one big drive. Okay, so the one big drive is like this, and then you get a second big drive, but inside of each one of these drives, we generally get 3 drives, 3 smaller drives. So you get 3 drives and then 3 little drives. So if I pull up our chart, you can see in here, and again, this is all outlined in the manual, so you get drive 1, drive 2, drive 3. So you can see in here, and I'm not sure, I can't really blow that up. I guess that's about as big as I can make it. See if we can make it a little bigger. But you can see in here it says A1 by, A2 by, A3 by. Then we got A1 by, A, B2, B3, and then we got C1, C2, C3. All right, so that's kind of how these markets move through their major drives and then their smaller drives inside of each one of the longer term drives. All right, so that's how it works. And so that's how, I learned this all back in Chicago, and that's how these guys look at these markets, and that's how they trade them. So be mindful of that. And of course, the picture is, that's a perfect picture. I mean, that's the way it would be if it was absolutely perfect. And of course, the market's never absolutely perfect, so you have to kind of make adjustments. So this is our first drive. That's our counter trend right in there. And so that would be coming in, and this would be our first break. This would be our A1, right? Actually, I'm sorry. Let's do it right. Let's be a B1 in here. So that's going to be a B1 right in there, and that's your second drive, the beginning, the first entry to your second drive. And then you have a little, and you could almost call it like this could be your, right here, this could be your B1 because that was your first break of the blue lights, and that's what you're really supposed to do, right? So if you want to look at that. And then it came down and kind of had this little pullback, and then it kind of, you almost want to merge those two. But technically speaking, that should be your B2 on this next set of little lights in here. So that's kind of how that all turned out. Kind of hindsight sometimes is a little bit better than doing it on the fly is a little bit more difficult. But if it was easy, everybody'd be doing it, right? So this is coming in here. The market's taking off and running, and now you got a clearing bar. This is called a clearing bar. And that clearing bar up there is a bar that has a higher high and a lower high. See that big? It's called a big tail that's coming out the top and bottom. Now, I've got kind of funny charts on here. I want to show you. You're looking at these charts and saying, "Man, these doesn't look like my charts." I'm trying to follow along. That's not what my Microsoft chart looks like. That's because I run something called the Heikin-Ashi bars. And so if I turn those off, this is more traditional of what you're going to be seeing. And then, of course, I've got the bulls and bears laid over the top, which is giving me the Fibonacci and Elliott waves setups. But this is what comes in if I turn on the Heikin-Ashi bars. And it's kind of a smoothing component. It makes it easier to read the charts and read these markets and read these different patterns. Now, I know not everybody uses them, but I like them. And so this comes in, and it ends up being, this is the little pullback, so that ends up being a B2 right in there. So that's going to be, that's your B3. So that's your B3. And once we get up into the B3, that probability is very low that it's going to continue higher up into the B3s. Doesn't mean it can't go to B4, B5, B6. It certainly can. But generally speaking, we expect it to come back and break the blue lights. Okay, so the blue lights will accelerate up in there. And as we go through the B1, B2, B3, we start to lose our momentum, and that probability statement, once again, if we look back at our probability table, you can see that a B2 right here is a medium probability. All right, so that's a medium probability, and B2s, and you see that we got them all listed in here for you, but they tell you whether it's a high or highest probability, your medium, medius probability, and then your low probability. All right, so we come in here, and as we count these up, drive 1, drive 2, drive 3, and then inside of each one of these drives, drive 1, drive 2, drive 3. Now we have another little sideways, kind of where the market kind of goes sideways and is indecisive at the top of the third drive, okay, at the top of the second drive in this case. Now we got this little sideways market. It did the same thing where it did this little double double thing where it went one, faked us out, and then tried to go again, and this is our little drive. So if we come in here, and we're going to come in here, and we're going to call this is a little bit of hindsight coming in here. Oh, okay, let's grab the text right here, and we're going to come in, and we're going to call that your C1. So now we're coming in, this is a C1 drive right here. So you have to be careful, because once you start getting up into the C drive, you have to realize that the probabilities of this thing going up and making lots and lots of money becomes less and less and less. So we got C1, so this is going to be a C2 right here. And then we come in here and right there. And then we got kind of this little pullback right in there. That little thing right there, that little pullback where we made lower highs right in there, but yet higher highs. That's a little pennant formation for those of you who are following along. We're real close. That's a little pennant formation. You can see back here, it's also a little pennant formation. You can see back here, it's also a little pennant formation. So these little pennant formations come back on these little breaks in here. Okay, so that's where you get your pennant formations. And then we're going to come in here. This is a C2. And then right in here, this is a C3. So that's our C3. And it doesn't mean it can't do a C4, C5, C6. Certainly can. It just doesn't do it very often. Okay, it's really rare. So at this point, C3 comes up, and that's your new high right there, and it failed, which is exactly what you would expect. You expect the C3 to fail, and it did. It came up, and it broke the blue lights. So that's where it tanked, and we would expect this market. Now we got to label these downsides too. So we got to go label the downside. So we're going to come in here, and I'm going to label these for you real quick here on Microsoft. We'll take a little bit of more time here on Microsoft, and then it'll make us go faster on the other ones, all right? So this is going to be an X1. Why do we call it an X1, Lan? Well, we call that an X1 because it's the first exit of the first drive, right? So exit 1, that's what that means. So that's your first exit. So if you got in on an A1, you're going to get an exit on the X1. Now the market's going to go sideways. It's a counter trend. The trend is your friend until it bends or ends, right? So we want to trade the trend. We don't want to trade the counter trend. We don't want to try and take a short position here, because the counter trend, we're in an uptrend. We're making higher highs and higher lows. This is just a counter trend. So it's going to be very shallow, okay? And then we're going to look for it to break the counter trend, and that's going to be our buy point. And boom, we're going to look to get back in once again and take the next leg up. So that's going to be the B drive. So then we're going to go through the B drive in here, and that's how this works. So that's X1, and then we're going to come in here. And that little breaking of that blue light right there where I got those white arrows pointing, that's going to be your X2, right? Now, of course, we can count these going the other direction too, because not only markets don't only go up, they also go down. And so again, if we look over at our cheat sheet over here, you can see we got them counted going down as well. Now, I'm not going to get into the downside because it starts getting, a little bit beyond the course, the scope of this class. Again, you can go get all this information over in my manual on YouTube, and it's all documented in there. And we come in here, the workbook for this class, and there we go. There's X2, and then the market starts to rally once again, and then this, as we come up, we draw our trend line across the bottom of these bars, and it exits out at that same spot, the third drive right there. So drive 3, that's going to be our X3 right there, and we're going to come in, and boom, 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 there's our X3. All right, now the market's making a topping formation. This is called a topping formation, and technically speaking, this is going to be a new A1, right? So it's an X3, and technically coming down the other side, so we should really come in here and label that. That's an X3 to the upside, but what is it to the downside? It's actually an A1S, right? It's the first drive to the short side. So if we're going to take a short, that would be our first opportunity to take it to the short side. It's called an A1S. We put the S to the short side just to label it. We don't put L for the long sides. We just assume long. And say, okay, so now we're coming in here, and this is what we would expect for a little ABC pattern coming off the top. A, B, and then we look for this thing to come up. And now it came all the way up, and it actually broke the previous high, so it kind of threw off our little ABC to the downside pattern, right? We kind of expect this market to come down, but Microsoft's too strong, so it kind of blew this thing off, and it's getting some good AI out there push, and people want to buy it, and so it's not getting a full ABC retracement back down into the Fibonacci sweet spot or down into here, and so it looks like it wants to start to rally and start a new series of 3 drive patterns. So if it does that, well, that's great for us who want to go long Microsoft. We're just going to jump in and take this thing on the next level up. So that means that this is going to come in, and it's got to stay above this high, okay? So the rules are higher highs and higher lows. If it comes down and it starts breaking back down, now it certainly can do it from here. It can come down and start to break down like this and go with the smaller downside, right, that little fractal, and still break down. And it could do that, but what's going to be the key is those blue lights right there, right? So what we're looking at right now is now a good time to get into this market to the long side. It looks like it wants to go, but remember, this is actually an A1 right here. So an A1 is, we don't generally want to take A1s, right? A1s they fell a lot, but this one looked like it worked, and this would be our, actually, if this comes in here, if we come in and we break those blue lights, that's going to be a B1, and that would be a really nice place to get in. Not B12. We're not taking vitamins. We're coming in here. This is B1, all right? So right here, B1. So if it breaks those blue lights to the upside, it's going to be a B1. Now notice that it came down and it bounced right off of that blue line. What is that blue line? That's an exponential 100-period moving average. That's a very common place for a market to bounce. It comes down, touches these moving averages, and then it likes to turn. We call those stop lights, or I like to call them yield signs, because they like to blast. How many of you blast through your yield signs and don't stop? Well, we do that in the stock market too. The markets like to blast through these yield signs. And so rather than calling them stop signs, we'll just call them yield signs. But this is the 200-period moving average, and that's a yield sign as well. So when they come down, sometimes they'll reverse and go off of that. And so we're looking for and anticipating an A, B, C, D pattern, A, B, C, coming up. You're buying on the valleys, buy the valleys, sell the rallies. So your first break is here. This is your spider web. Your next one will be the mathematical model, which is right there, crossing of the blue light. And then, of course, you got your horizontal line. And then we're going to look for what? We're going to look for the next reoccurring price pattern, which is what? A Fibonacci bow tie. We're going to look for that thing to come up, test that 130.9, and come back and test here. And this would be another place where we could come and look to get into the market to the second run. And this is where you're going to look for this market to rally once again. All right, and we're going to get that little drive 1 in here. This would be our drive 1, this would be drive 2, and this would be drive 3. And so that's where you're going to look for these probability statements to come into play, and that's what we're going to look for here on Microsoft. Where do you want to buy? Well, heck, right now would be a great time to buy the valley right there in anticipation of the market coming up and breaking higher. Now, sometimes the bad thing that these markets can do is they don't always follow all the way through to the full Fibonacci projection, all the way to 130.9, 160, 200, all the way up here. Sometimes they just come up and they touch 61 or they touch that 76.4, and then they flush back down and make an ugly little bow tie like that, and those are no fun because you don't make money off of them. So you have to be careful and mindful of that. Sometimes the market will come in and it'll do that other pattern that we talked about of coming up here like this and then pulling back and then rallying at that point. So you're going to get these little ABCs in there, remember, because you're going to get your little fractal ABCs. This is just a B1 right here. And so we're going to come in and we're trying to preempt the B1. So now would be a good time. We can come in here and let's come in here and we'll just come in. We'll go out. We'll do a 100-day option. Now, how do you pick how much time you need in an option? Now, Doc Brown's got his rules. I got my rules. I like to do it with a Fibonacci projection ruler. I like to come in and say, well, if the market's going to be at a certain price and time, which we can project, right, and I want to stay in it for all three drives, drive 1, drive 2, drive 3, where would that be? Well, if we come in with our next Fibonacci ruler and we can just kind of, do a swag. You know what a swag is? It's called a scientific wild-ass guess. Now, we don't want to wag. We don't want to just be a wild-ass guess. We want to be as scientific about our wild-ass guesses that we possibly can. So we're going to come in here and rally up, pull back down. If it comes back down and tests this previous high right here at about the same rate as what it did before on this little bow tie, we're going to make a projection that this market might be out here somewhere around 100, 130.9, right around September 6th. So that means I want to go out 30 days beyond September 6th. So September, October, I want to look for an option that expires in October. So 10, 18, that would be a good 135 days. That's going to give me plenty of time. If I wanted an extra month on there, I could do the 11s, but that's how I kind of figure out how much time I need to buy. I don't want to buy too much time, but I don't want to buy not enough time either. All right, I want to buy the amount of time that I think I'm going to need. Now, if I think I might want to get in and out a couple of times, I don't even need to buy 135 days, right? So we're going to come in here, and very quickly, I'm just going to come in. We're going to drag this thing up here, open up our window, and we're going to come into our options chain, and we're going to look at our options chain in here, and we're going to say we want to buy a call option, and it's 135 days at the money option, 2,535. We'll come in here, and we'll buy one of those. I know Doc Brown's going to come in, and he's going to buy 35 of them. That's fine. I'm not Doc Brown, all right? We're going to buy one, okay? So we're going to come in here, and we're going to come in. I can't put it on right now, obviously, because the market's closed. We just barely closed. Oh, the market's still open. What am I talking about? Let's come in here and just put one of these on. We're going to put one of these on here in the classroom account. So there we go. We got our long position. We'll kind of watch that and see how it goes over the next few days, the next couple of weeks while I'm here as your temporary school teacher. All right, I'm here as your temp. I'm taking over for Doc Brown for a couple of days. We're going to do things my way, a little bit different. If you like my way, you can always come and join me on YouTube. I have my own YouTube channel. It's out there called Trade Mentors, youtube.com/Trade Mentors. And every morning I'm live on YouTube at 7:25 a.m. Mountain, and of course that's 9:25 a.m. Eastern Time. Just go search for me, Trade Mentors on YouTube, and you can come and join my class. But that's what we do out there. But this is the stock market trading channel, and we do very special things here that we don't do out there. Okay, so you're in the right place today, and tomorrow maybe you can join us in the morning to watch the markets in the morning. All right, so there we go. That's what we're going to do with Microsoft. Let's go over and very quickly jump and see what else Kramer has for us. He has Microsoft, then he says NVIDIA. So we're going to go look at NVIDIA. Let's very quickly pull up NVIDIA. Everybody's all excited about NVIDIA. So we're going to look at NVIDIA in here. So there's NVIDIA, and we're going to look at the same basic pattern, right? After a while, trading becomes monotonous, right? We just A, B, C, D land, A, B, C, D. 3-drive pattern land, 3-drive pattern. So we're going to come in here and we're going to look. See, so this is drive 1, we got drive 2, there's drive 3, and we got up into this top range right here. So there's our, if we come down here, this has got to be right here where that arrow is. See where those 3 arrows come in? This is going to be A1, A2, is that A3 and a failure, or is this A1 right here? I think this is more A1 down here. It got a little flat, but that's because the market was, oh man, this market just went parabolic, didn't it? So we're going to come in like this, and this market started to rally. We got drive 1, drive 2, drive 3, drive 4. Let's call this right here. We got hindsight, so we can come in here. We're going to just call this one right here A1. All right, so we can count it backwards, and then that helps us go forward. So we got to look at the past to know what the present. So that's how this works. We're going to call that A1. That means this is going to be B1. And I'm not going to label all of them in the interest of time. We're just going to come in here. This is B1 like that. And that's going to be our C1 right there. Is that C1? Or is that going to be, yeah, that's a C1. Let's call that C1. So there's our C drive. So there's our first drive. It's kind of small. We could actually call this A1 here, A1, B1, and then that would mean that the C1 failed. Okay, so that's why I didn't want to call that C1 up there, because C1 didn't fail here. So this is actually, if you kind of want to combine them, hindsight's 20/20. You can see this is your first drive, right? So that's drive 1, started way back here. So technically speaking, if you're going to combine these drives, and we can do that with hindsight, we can come in here and say that's A1. So this is our B1 drive, and that's our C drive. So this is drive 1, drive 2, drive 3. So what that's going to do is it just helps us identify by looking where the market's at in its new drive system. So we're going to come in here. Now we can see that we got a little pullback here. So that's your new pullback, and we got our new drive 1. So this is our new drive 1, and man alive, this thing's going to the moon. And this has been a good market for me. I've made a lot of money in this market and been very happy with it. So as we come in here, this has been, let's call this a new A1 right here, right? This is a new A1. And we got hindsight, so we can call that an A1, and that's going to help us count it going forward. Now, each one of these little pullbacks is an opportunity for us to add on to our position. See, higher highs, higher highs, higher highs, lower highs right there. Higher highs, higher highs, higher highs, lower highs. Now we're getting up into high probabilities or low probabilities of success, right? The higher we get, we're going to count these out. So that's why we go back and we count where we're at in the drives here so that we can figure out where we're at in the counts here. But we know this is a nice little pullback, so this is an A1. We're going to come in here. This is going to be an A2. And then that one right there is going to be an A3. And then we got an A4, and that's pretty rare. Don't generally get A4s. So we got this, of course, this market's rare, right? This is a rare market. Each one of these little drives is a little count that we count in here, just like that. So now we got A1, which is the mathematical calculation, right? The break of the blue light's always A1. So the blue light breaking is always A1. And then we have, and look, we almost got like a little A5. Look at this little tiny one right here came in that broke the blue lights, pulled back, lower highs, stayed higher lows, and then it rallied once again. That's almost like in there. I'm just going to call that all A1 right there, all right, because it broke through the Fibonacci sweet spot, which is the yellow bars. We got the arrow, and away this thing went. That's A2, A3, A4. So we're in an A4. That's rare. So we're getting up into a very low probability of success of this thing continuing higher without giving us a pullback. So we want to go into A2 drive. So it's like, where do I get into this market land? I've got so much FOMO. I want to get in right now. Well, if you want to get in right now, and I know we all do. We all look at a market like this and we're like, I want to get in, but the probabilities are really low of success because that means it's got to come back at some point and people are going to take profits. So you take your Fibonacci ruler and you drag that in there and you come up to where this market peaks out. We don't know where it's going to peak out, right up in here somewhere. Probably going to peak out. And then we're going to see it kind of pull back into the Fibonacci sweet spot. Let me get my right tool in here. I'm going to get it back into something like this. And then what's it going to do? It's going to come back into the sweet spot. People are going to take profits. They're going to start buying again. It's going to push it one more higher. That's where you get your A, B, C pattern, right? A, B, C, and then D. Is it going to come back and pull back all the way into the Fibonacci sweet spot? Usually it does, or at least it comes back and bounces off some of these moving averages, or comes back and bounces off these Fibonacci numbers like 38.2, maybe comes back to 50%. I doubt this market might come all the way back to 61.8. How far back did it come last time? Let's look and see that last drive. We're going to measure that last drive of the Fibonacci of that C drive. We'll measure from the bottom of the C drive to the top of the C drive. And see, that thing came right back to 61.8, which is our Fibonacci golden ratio on the downside. So there it came right back to 61.8, turned and started to take off one more time. So that's your ruler. That's how that Fibonacci sweet spot works. And if you're not familiar with Fibonacci, you don't know how it works, you don't know how to use Fibonacci and Elliott wave combined, it's kind of like hamburgers and french fries. They go one hand with the other. If you're not using Elliott wave with your Fibonacci ruler, you might as well throw your Fibonacci ruler out the window because you're not doing it right. And I can promise you're not doing it right if you're not using Elliott wave. And if you don't know anything about Elliott wave, why are you using Fibonacci? Fibonacci is the way of measuring Elliott waves. So go get the manual and learn, okay? If you just learned half of something, if all you're doing is going to McDonald's and getting the french fries and you're not getting the Big Mac, hey, you don't have the Happy Meal, all right? No Happy Meal. Let's come in here and let's see what we're going to expect or anticipate. We're getting up into a region where we got very low probability of this thing continuing higher. But I want to buy it, Lan. I want to buy it so bad. I want to get into this thing. Well, what you can do is you can come in and you can do what we call a married put, all right? You can do a married put. Now, you could do a bull call spread. You could do some other of these things that have downside protection. But a married put is where you come in, and you just very simply come in. And this is going to be an expensive purchase because these things are trading at $1,000. It's going to be difficult to do a married put here. You're going to probably have to do some sort of a bull call spread where you buy an option and then, sell an option, collect a premium, sell some premium. We're going to do some of that stuff. It's a little bit beyond the scope of this class, but there's some other different ways you could do it. But a married put, you'd buy 100 shares. Now, do we have enough money? We don't even have enough money to do 100 shares on this market. But a married put, you'd buy your shares, and then you would buy the downside position. Now, we could do a delta 50, right? So we could buy 50 shares. That'd be $61,000. We could actually do that. But then we would buy an option, a put option at the same strike price. So here's how we would do that. We'd come in here, we'd buy our 50 shares. So we got 50 shares, we bought them, and we're like, oh, great, I feel great about this. I just bought myself a really expensive market, NVIDIA, and it's really high, and it's the top of the third drive, and it's actually not a very good probability of getting in. But you wanted to get in so bad because you wanted to get in on this market. This is usually where you lose money because the market will go up into the C drive up here, the count C drive, and then it flushes, right? And you lose a whole bunch of money, and so you get out down here in the valley right when it turns around and starts to go back up again. You're like, oh, crap, I missed it. I was in there, and I was making money. I bought high, and I sold low. That's not the way you make money with these markets. But you wanted to get in, so what you want to do, you want to make sure that if you're going to get in, you want to go ahead and you want to protect yourself to the downside. Well, I'll just put a stop in there, Lan. Well, you might just get stopped out only to have it turn and run once again, and then you'll feel bad again, so don't use a stop. Well, I'll put a stop back here then. I'll drop my stop in here. I'll drop my stop back in here. Well, this is a big market. If you put your stop in here for 50 of those, and you get out if it breaks just one price bar back, and you put your stop in there, how much money is that? Well, that's a big risk. That's a loss of $9,000. You don't want to lose $9,000? No, I don't want to lose $9,000. Okay, then don't use a stop. What are you going to do? Don't use a stop. Lan, what if the market goes and crashes? I need a stop in there. Well, don't use a $9,000 stop. Let's come in here, and we're just going to buy a put option, all right? So we're going to come in here, and we're buy a put, and we'll just buy that put. Let's go a little bit further out. Let's do the 16-day. We're going to do a soft stop here. So we're going to come in here, we're going to buy a put, and we'll just put it right at the same price, right? So we'll just go in there, and we'll come in, and we'll go ahead, and we'll buy that. Now, we got a Delta 50 on here, and I'm sure Doc Brown's talked to you about the deltas. So an option at the money is a Delta 50, right? So that means that it's buying and selling, or it's making or losing as much money as whatever the delta is. So if it's at a Delta 50, it's making or losing as much money as 50 shares. So we've got 50 shares, so we got a nice hedge on here. Now, if the market does flush and fall, the delta is going to increase, and we'll actually make more money if the market falls than we will if the market rises. If the market rises, we'll probably lose as much on the put as we're making on the call. But this is a nice place to be taking a short position, but also have our long position because we wanted to get in long because we wanted to catch a great market that's going higher. You still got your long shares, okay? And you can cut your put option. You can bring your hard stop in at break even. And that way, if it does flush back down, you get out at break even and you don't get out with a $9,000 loss. But if it does flush at this point, hey, you're going to make a whole bunch of money on your put option, all right? So that's called a married put, and that's how you do that. And that's how you protect yourself to the downside. And that's NVIDIA. All right, now we've gone through and we've talked about 3 different stocks that Jim Cramer has outlined for us. He's got a bunch more in here, and I'm not going to go through those in the interest of time. You can go through. I've just scrolled down through them. You can see which ones those are, and you can go ahead and you can do this analysis yourself, and I will meet you again back here possibly tomorrow. I can't do videos every single day. I know Doc Brown comes in here every single day, but I'm also teaching other classes, and I'm going to try and do as many of these videos as I possibly can for you, but I'm going to try and do it at least every day. I'm going to try and do every day if I can, but some days we may miss a day or two while Doc Brown's on vacation because I got other classes I'm teaching. So come and join me over in my other class out there on YouTube if you would like. And happy trading. Hope this helps, and we will see you again hopefully tomorrow. Take care.
We hope you enjoyed this window into Land Turner's Fibonacci and Elliott Wave stock market trading strategies. As always, we want to remind our traders that the market is full of opportunities, but not without risks. Past performance is not necessarily indicative of future success. Stay engaged with Stock Market Trading Channel for more insights and expert analysis to guide your trading journey. If you would like a copy of Mr. Turner's 220-page workbook, the manual to this class titled The Fibonacci Effect Stock Market Playbook of Strategies, search Lon H. Turner on Amazon.